Hey everyone, and welcome to this explainer. Today, we're diving into what I think is a totally fascinating financial paradox. Seriously, have you ever stopped to wonder why the ultra-wealthy actually embrace having millions of dollars in debt, while the rest of us, well, we're taught from day one to be terrified of it. Most folks spend their entire lives just trying to avoid debt at all costs, right? Thinking of it as this stressful, dangerous thing. But today, we're going to flip that script entirely. We'll look at exactly how the world's richest investors use borrowed money not as a burden, but as a highly strategic tool to build massive fortunes.
Here's our roadmap for today. First, we'll look at the wealthy debt paradox. Then, bad versus productive debt. Next, acquiring and amplifying assets. After that, tax perks and liquid cash. Then we'll cover the ultimate growth tool. And finally, master the tool, manage risk. Let's get right into it.
All right, starting off with Section 1, the wealthy debt paradox, fearing versus embracing debt.
So if that is just so inherently terrible, we really have to ask ourselves, why in the world do the richest investors, real estate moguls, and top entrepreneurs strategically pile it on? Why carry millions in liabilities when, let's be honest, they could easily just pay cash for almost anything? Well, the answer comes down to a massive shift in mindset.
Just think about the divide between these two mindsets. For the average consumer, debt is inherently dangerous, right? It's a trap you gotta frantically dig yourself out of. But flip that mindset and look over at the wealthy investor. They strategically embrace debt as a calculated lever, literally hoisting more money into their own pockets. It's not about being reckless at all. It's about fundamentally understanding how money actually works.
Moving right along to Section 2, bad versus productive debt, the paradigm shift.
And here is the absolutely crucial point, the golden rule, if you will. Not all debt is created equal. Bad debt? That drains your pocket. Think swiping a high-interest credit card to fund a luxury vacation you're going to forget in a week. Productive debt, though, is the exact opposite. It's the engine you use to acquire income-producing assets. You're borrowing money to buy things that generate cash flow or appreciate in value. And ultimately, that puts more money back into your pocket.
Now let's see this in action with Section 3, acquiring and amplifying assets, the engine at work. Okay, imagine a $500,000 piece of real estate. Now, instead of sinking $500,000 in cold, hard cash, an investor puts down just $100,000. They borrow the remaining $400,000, and here's where the magic really happens. The rental income covers the mortgage, the taxes, the maintenance, and hey, it still kicks out a profit. The tenants are quite literally buying the asset for the investor over time. How crazy is that?
Now let's scale this up to really see the power of this strategy. Imagine an investor has a cool $1 million of their own available capital just sitting in the bank, ready to be deployed. If they buy something outright, they control exactly $1 million in assets. Sure, not bad, but by utilizing leverage, borrowing money against that capital, they don't just buy one single asset. They can now control several $1 million worth of investments. When those investments rise in value, their returns are calculated on that massive, amplified asset base, not just their original million. This lets them earn significantly higher returns than they ever could by just relying entirely on their own cash. Which brings us to Section 4, tax perks and liquid cash, the hidden efficiencies.
You know what's truly fascinating? It's how the wealthy use debt to preserve their liquidity. A massive mistake average buyers make is tying up all their cash in a single purchase. Wealthy individuals, on the other hand, finance assets so they can keep their cash right there on hand. Why? Because it gives them agility. They can strike instantly. Whether it's capitalizing on a sudden market decline, funding a new business that just popped up, or covering a totally unexpected emergency, keeping cash fluid means you never miss out on a lucrative opportunity.
Let's think about cashing out stock for a second. Selling assets outright triggers massive capital gains taxes. Nobody wants that. So what's the alternative? Borrow against the asset. Ultra-high net worth individuals use securities-backed lines of credit to get cash entirely tax-free, all while their stock portfolio just continues to grow in the background. It is literally a win-win situation.
And this strategy becomes incredibly powerful when you factor in tax codes. Tax laws actually heavily incentivize this exact type of borrowing. You can often deduct mortgage interest on investment properties, and businesses can deduct interest expenses associated with their loans. So strategic debt literally reduces your taxable income while simultaneously supporting your continued financial growth. It creates this amazing financial efficiency that makes holding debt incredibly profitable.
Let's look at another angle in Section 5, the ultimate growth tool, scaling businesses rapidly.
Let's quickly run the math on scaling a business. Watch how these numbers play out. If an entrepreneur borrows money at an 8% financing cost to, say, buy some new equipment, but that equipment generates a 20% return, well, they pocket that 12% spread. By capturing that difference, the owner scales their business incredibly fast, profiting immensely from capital they never even owned in the first place. Finally, we arrive at Section 6, Master the Tool, Manage Risk, the reality check. Now, I want to be super clear here. Debt itself doesn't magically create wealth. At the end of the day, it is simply a financial tool. It completely destroys wealth when it's squandered on depreciating consumer lifestyles, luxury toys that produce absolutely zero financial return. It only builds fortunes when applied meticulously by carefully analyzing risks, cash flow, and market conditions to acquire true, cash-flowing assets.
So, having explored exactly how the world's wealthiest individuals harness the incredible power of leverage, liquidity, and tax efficiency, we are left with a massive shift in perspective. The lesson here definitely isn't to rush out and borrow recklessly. Rather, it's to understand how money truly works. So as you look at your own financial journey moving forward, I'm going to leave you with this ultimate question to chew on. Based on how you use it, is debt your enemy, or is it your wealth-building engine?